All right, let's jack in. Forget what they told you. The market isn't about PE ratios and earnings calls. That's the loading screen. The real action, it's a game, a simulation. And like any code written by humans, it is full of bugs, glitches. We're here to hunt them.
So, when the guy who called the entire 2008 meltdown says something is insane, you know the suits on Wall Street, they pay attention. They nod along, they straighten their ties. But here's the secret. They weren't scared of the market. They were scared of us. And this is where it gets really interesting. Burry was absolutely right. The whole situation was dangerous. But the real danger wasn't a bunch of retail traders with stimulus checks. No. The real danger was what happened when those apes found a glitch in the matrix that the architects never, ever wanted anyone to see.
So first, let's just load up the official program. You know, the one they hand you in business school. It's called the Financial Independence Retire Early Dream, the straight and narrow path. The official story, it starts right here. Picture this, you're 24 years old, fresh out of school, and you're already stacking paper. You're on the path. You're doing everything they told you to. Right. Now, fast forward. 20 years of grinding away in a cubicle. You're 44 and you're almost a millionaire. You can see the finish line. You sacrificed, you saved, you did everything by the book. And then, finally, the end game. You hit your number. 5.8 million bucks. You can finally walk away. The system worked. Or, at least that's what they want you to believe. This right here, this is the gospel according to the suits. Max out your 401k, dump it all into VTI, and just wait. It's slow, it's steady, and it requires you to basically sacrifice the best years of your life to some corporation. It's designed to be boring because boring keeps you compliant. But what happens when you zoom in on the code? You start to look at the human cost of running this 30-year program, and that's when you start to see the cracks. Now check this out. This quote comes from someone with a net worth of $5.8 million. This person won the game by the official rules, and they're still exhausted, still feeling that grind. They traded their actual life for a number in a bank account, and now they're left wondering, was it even worth it? And that's the key question, isn't it? What if the biggest risk isn't losing the game, but winning it? What if the safe path they lay out for you is really a trap, just designed to slowly drain you while you build up a pile of cash you're too damn tired to ever enjoy? This is the question they are terrified of you asking. Which, of course, brings us to the main event, the day the simulation glitched out for everyone to see, the GameStop saga. This was the moment a bunch of so-called dumb money found a bug in the code and exploited the living hell out of it. Now, to get what happened, you have to understand the weapon the suits were using. It's called short selling. Basically, you're betting a company will fail. You borrow some shares, you sell them immediately, and you pray the price tanks so you can buy them back for pennies on the dollar. Think of it like this. You sell your neighbor's lawnmower for $200, then a freak blizzard hits. Nobody's mowing their lawn, you buy it back for $20 and pocket the change. Easy money, right? The catch is, you have to give that lawnmower back, no matter what it costs. And that's the squeeze. The suits shorted GameStop more than 100%. They sold more lawnmowers than actually existed. Then, the apes on Reddit did something simple. They just started buying, holding. Every share they bought was one less lawnmower the suits could find. The price went parabolic. That blizzard turned into a heat wave. And suddenly, the suits had to buy those lawnmowers back at any price, from the very apes who were diamond-handing them. And the price for those lawnmowers? Well, Melvin Capital lost 53% of its entire fund in 1 month. D1 Capital was down $4 billion. That's billion with a B. The apes proved that a decentralized group of outsiders could use the market's own rules against the insiders. They found a cheat code. But here's the thing about finding a cheat code that lets you print infinite money. The game developers don't just congratulate you. They release a patch. And in this casino, the house does not like to lose. Let's look at the timeline because the data is damning. January 27th, the squeeze is on. The rocket is taking off. The system is at its breaking point. Then, January 28th, the impossible happens. Brokers like Robinhood just turn off the game. You could sell GME, sure, but you couldn't buy it. They literally removed the buy button. They cut the fuel line to the rocket ship in mid-flight. Now, the official story was a collateral issue. But then came the lawsuits, and internal messages like this one popped up. This is Robinhood's president talking about a call with Citadel, who, by the way, just happened to be bailing out Melvin Capital. A total mess. Yeah, it sounds like it was about a lot more than just collateral. It was about pressure.
And it all boils down to this one question. Are we playing in a free market where the smartest players win? Or is this a rigged casino where the house just changes the rules whenever it starts to lose? The data from that day in January points to a pretty clear answer. The GME glitch got patched, but the game itself was changed forever. Because now the apes know the code is breakable, and the hunt for the next bug is on. Because the truth is, the kind of risk that blew up Melvin Capital, it isn't just in some random video game stock. It's hiding everywhere, right in plain sight. I mean, think about the safest stocks in the official narrative. You know, blue chips like Kraft or Coca-Cola. Rock-solid investments, right? Well, the ape theory says to look for hidden risk. Right now, San Francisco is suing those exact companies using the same playbook they used against big tobacco, claiming their products are a public health crisis. That's not market risk, that's systemic risk. And the suits are not pricing it in.
So what's the big takeaway here? It seems like you've got two choices. You can play the game the way they designed it, the 30-year grind for a quiet life. Or you can accept that the whole system is just a matrix of code, and you can start looking for the bugs.
Now let's be crystal clear. This is just educational banter. It is absolutely not financial advice. The market is a casino, and the house has an edge. We're not telling you where to place your chips. We're just pointing out when the dealer starts to look a little nervous. We are watching this chart like a hawk. While you wait for the next candle, grab your free gear. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or grab your NVDA stock on Moomoo. All the links are right there in the description. Smash the like, subscribe to the tribe. Apes together strong.
So, let's leave it with this. The suits built the casino. They own the tables, but the apes are learning how to spot the glitches. So the question is, what are you watching for? What's the next tell? Drop your theories down in the comments. Let's hunt together.